Possessing $1,000 often feels like a point of security. The instinct is to take that cash to a traditional bank and leave it there, believing that a vault is the safest place for a financial foundation. But the moment that door slams shut, your money stops growing for you. The bank immediately takes your deposit and lends it out to other consumers, charging upwards of 20% interest on credit cards, while paying you almost nothing for the use of your capital. With the average traditional savings account paying roughly 0.05%, $1,000 will generate only $2 in interest over 5 years. When adjusted for the rising cost of living, this static storage guarantees a slow decline in your actual purchasing power. A $100 bill possesses no more skills than a 20. It simply offers more power to acquire income-producing assets. To protect your net worth, you must stop viewing cash as a static safety net and start using it as an active tool. This requires a sequential, 5-step transition from saving to investing. The first strategy is to eliminate high-interest consumer debt. Before looking at the stock market or real estate, you have to stop the wealth you already have from leaking away. This chart compares debt repayment returns against traditional investments. Carrying a credit card balance at 20% means paying it off guarantees a 20% return. That more than doubles the stock market's historical 8% average. Boosting your cash flow starts with removing mathematical drags like late fees and unused subscriptions. Americans pay an average of $250 a year in late fees, capital that provides zero value or return. Eliminating high-interest debt functions like plugging a leak in a bucket. Without this step, your wealth-building efforts will be consistently undermined by interest payments. Strategy 2 is the establishment of a defensive financial baseline, the emergency fund. Currently, 60% of the population lacks the liquid cash to cover a basic unexpected expense, like a medical bill or a car repair. These minor crises are often the primary drivers that force people back into high-interest debt. This reserve should sit in a high-yield savings account at an online bank. Because these institutions have lower overhead than traditional banks, they offer interest rates providing a better return on your liquid cash while keeping it accessible. An emergency fund acts as a moat around your future investments. It ensures when life becomes unpredictable, you aren't forced to liquidate your wealth-building engines to survive. Once defenses are set, the third strategy involves entering the stock market. Trading your cash for shares makes you a partial owner of major corporations. Buying individual stocks carries significant risk. A single product failure or corporate bankruptcy can turn a $1,000 investment into zero overnight. Index funds solve this by spreading your capital across hundreds of different companies at once. This diversification ensures that your portfolio tracks the growth of the general market rather than the fate of a single business. Profitable companies often distribute a portion of earnings directly to shareholders in the form of dividends. These quarterly payments provide a stream of passive income for simply owning the stock. This flowchart illustrates the mechanics of a dividend reinvestment loop. A cash payout automatically flows back to purchase additional shares. More shares lead to larger dividends, buying even more shares. This cycle accelerates over a 10-year timeline, creating a compounding effect requiring no additional labor. Over time, these funds transform a static $1,000 into an autonomous, self-replicating engine of passive wealth. The fourth strategy is to acquire exposure to real estate without the high capital requirements of traditional property ownership. Usually, $1,000 is insufficient for a down payment, and it certainly cannot cover the costs of managing physical tenants or maintaining a building. Modern platforms like real estate investment trusts, or REITs, provide a workaround. These are companies that own and operate income-producing properties, like apartment complexes or commercial office space. By law, REITs must distribute 90% of their taxable income back to their shareholders as dividends. This allows small investors to participate in the real estate market and collect rental income, while entirely bypassing the physical labor of property management. Passive investing is a long-term game. A 10% annual return on $1,000 only generates $100 a year. Strategy 5 is the pivot from passive markets to active skill acquisition. If you have low capital, your highest returns will come from investing directly in your own ability to generate value. This involves front-loading effort into a digital business, such as a blog or a media channel.
These pseudo-passive assets require intense initial labor, but eventually generate automated revenue. You don't need the mass celebrity status of someone like Kim Kardashian to succeed. Highly profitable digital businesses often operate within small, specific niches where you provide targeted value to a dedicated audience. For those starting with limited capital, using $1,000 to acquire a new skill can create a recurring monthly revenue stream. This result far outpaces the modest yields of the traditional stock market. Which strategy you choose depends on your current financial momentum. If you already have a recurring income stream, layer strategies 1 through 4. Pay off debt, build your moat, and consistently put your extra cash into index funds and real estate trusts. If $1,000 is your only asset, you must execute strategy 5. Use that capital to learn a new high-value skill that allows you to start generating more active income immediately. Financial advice only works when it is contextualized to your specific starting line. Albert Einstein famously referred to compound interest as a force capable of building immense wealth over time. But the compounding process only truly works if there is a primary engine of capital to finally ignite it. Your first $1,000 marks the point where money shifts from a static savings goal to an active financial catalyst. This matrix compares the effort, risk, and timeline for each of the 5 strategies. Success is not about a lucky stock pick. It is about choosing the right strategy for your current situation and putting your money to work.